Today, we are looking into sources of finance for business organization. A firm, whether small or large, has two broad categories of financial sources, or simply put, how they can raise capital. These can be internal or external sources. Internal sources, these are ways by which capital is provided within a business enterprise. External sources, these are ways by which firms raise capital outside the organization. Small firms. Internal sources of finance for small firms. Personal savings, this is a common method used by sole traders and partnerships form of business where their personal saved money is converted to capital to start the business. Ploughed back profit, this is a process of reinvesting part of profit made by a business concern. It is also termed self-financing. External sources of finance for small firms. Borrowings from friends, relatives, or other persons in order to begin or expand the business. Borrowing from banks, provided they have the necessary collateral security. Loans from government through financial institutions, example, Nigerian Bank for Commerce and Industry. Example, NBCI, the Industrial Development Bank, IDB, and so on. Merging of small businesses to form larger units in order to increase the size of capital available for business operations. Purchase of goods on credit provided the business is credit worthy. Large firms, example, joint stock companies. Internal sources of capital for large firms. These include contributions by the founding members, which may be later converted to founders' shares. Retained profits, this is a form of expansion to firms by plowing back some of the accumulated profits. Use of depreciation funds, this is the money set aside for the replacement of worn-out machines and other durables capital. This money could be used before the time is due for the replacement of the machines or equipment. External sources for large firms. Selling of shares, this is a major way by which large firms raise capital. These shares could be ordinary shares or preference shares. Buying on credit provided they are credit-worthy. Taking loans from commercial banks in the form of overdrafts or short-term loans. Investment trusts, these are companies that are specialized in giving loans to firms for industrial development, example, insurance companies, building societies, and so on. Finance corporations, these are business units set up by the government for the purpose of giving loans to business for development projects.